What is going on, everyone? What is going on? Happy Thursday. I am so excited to be here. We were supposed to do this last week, but I got sick. My daughter got sick. Everybody in the world seemed to be sick last week. But we are here today and we are talking about tips for a tax free 2026. So I'm super excited about this topic. I'm going to just do a quick systems check here, make sure that I am connected and live currently on LinkedIn. I'm going to check in and make sure that we are good and we are streaming here live on YouTube as well. As you are entering, go ahead and let me know in the comments where you are viewing from. I'm so excited to have you here. Seriously, my name is Lauren Ballard. I am a CPA and a tax strategist, and I have been in the tax industry for over 15 years, and I am here to share with you how you can maximize and keep more of what you make every single year by implementing very intentional and clear tax strategy to help take you and your financial future to the next level. And so I am not seeing myself here on the live stream. So I just want to make sure that we are good before I jump into the content. But if you are viewing now, go ahead and put your comments in the chat. Let me know where you are viewing from. Let me know where you're viewing from. Okay, perfect. We are good. We're in the building. All right. So if you go ahead and let me know in the comments where you're viewing from, I'm going to jump right into the content here. And we have an amazing presentation. We are talking about tips for a tax-free 2026. And if you're viewing, just go ahead and by a show of hands or in the comments, let me know, when is the best time to do tax planning? When is the best time to do tax planning? And if you are not sure, the best time to do tax planning is right now. It's at the beginning of the year. And so I am going to be giving you an amazing opportunity for you to just start thinking about some things and putting some things in play for you. And this is going to be really important for you, especially if you are a business owner. So let's make sure I can go through my slides. Okay, very good. So strategy number one, it's the real estate entrepreneur advantage. So if you are like most people and you spend any amount of time on social media, you would have heard that real estate is an awesome opportunity for you to accumulate tax-free wealth. And so I want to explain the particulars about how that takes place. And I call that the real estate entrepreneur advantage. And so the IRS has established something called the real estate entrepreneur or the real estate professional status. And when you meet the qualifications that are presented here on the screen, you are able to treat losses generated by your rental real estate as a deduction against other income. So let me give you an example. And this is honestly the most common way that I see this take place with my clients. So usually one of the spouses, it tends to be with a married couple, but I've also seen this in practice with single individuals. So this is not leaving anybody else out. But for my married individuals, what I tend to see happen is that one of the spouses is working full time. They're making mid to high six figures, and the other spouse is actively pursuing real estate investing. And so what happens is that the real estate generates something called a paper loss. How does that happen? Now, you may already know this, but so just keep your thinking caps on. I want to make sure that you understand this for the people who are not familiar with this concept of a paper loss. So with a paper loss, what happens is that there is something called depreciation, which essentially means as you use items, they decrease in value. Well, the interesting thing about real estate is that they can decrease in value on paper, but appreciate or increase in value in terms of the market. And so the IRS does it based on when you put that property into service. And so if I place a property in service, the property is worth $1 million. The property is worth $1 million. I then am able to take depreciation against that $1 million over a particular amount of time. And depending on how much income I generated in that year, I could potentially have a paper loss, but I'm generating real cash flow. So that's how we are able to generate tax-free cash flow when we are a real estate professional. Now, as I said previously, you are able to use that those real estate losses to offset active income that is generated by you or your spouse. So if your spouse is a high W-2 earner, you can use that to offset their income. If you own another business, you can use that to offset the income generated from that business. However, this is the caveat: you must meet the real estate entrepreneur requirements. So what is that? 750 plus hours per year in real estate activities. Now, real estate activities are defined by the IRS. And so there's a particular criteria, and you got to make sure that the activities that you're doing meet those requirements. You need to spend more than 50% of your working time in real estate. So if you have a full-time job and then you're saying you're a real estate professional, that's not going to work. And then you need to meet those two requirements, plus you need to pass one of the material participation tests. And there is a series of 6 of those, one of them being 100 or more hours on the particular property and more than anybody else. Now, this is the thing. Let's say that you are single and you're like, listen, I love my job. I'm not trying to leave my job, but I'm trying to figure out how I can use real estate to lower my tax bill. There's something called the short-term rental loophole. And if you run an Airbnb type business, or if you use VRBO, you may be able to get similar treatment, even though you are not a full-time real estate entrepreneur. So this is tax strategy number 1 that we're going to look at, and we're now putting in our toolkit to have a tax-free 2026. So this is tax strategy number 1, meeting the real estate entrepreneur requirements. So here's an example of how this works in practice. If you have a business owner who makes $600,000 in income from the business, the rental property generates a paper loss of $30,000, you generate a tax savings of $12,000 just from owning and operating that real estate. Now, let's talk. So now that we have touched on and understand what the real estate entrepreneur loophole is and how you can potentially use that to have a tax-free 2026, let's next move to something I like to call the master's tax break. So if you know anything about golf, I don't know much, but I do know the Masters. I lived in Atlanta for a while and was very familiar with the Masters happening in Augusta, Georgia. There is something called the Augusta rule. And this is how this play works. You have a business, your business pays rent, and it is renting property, renting space from your primary residence. And by doing this, you are now able to generate a business deduction. And for you, what does that mean? You are now able to take in tax-free income. So I love to recommend the Augusta rule, or how I like to coin it, the master's tax break for my clients, especially around the holidays. So the holidays just passed. We're doing this live in January, but I recommended this to every single one of my clients. And I said to them, hey, see if you can host some type of end of year holiday party at your primary residence so that we can take advantage of this. And you can get this deduction for your business. So there's some things that we need to keep in mind in order for this to work. Number one, it needs to be for an actual business activity. We cannot take advantage of the Augusta rule if it is not actually for a legitimate business expense. Second, the rents must be fair market value. So I tend to have I have a process where I look at market rates when I'm working with my clients, and we determine what is that fair market value for your particular property based on properties in your area. And then finally, we need to make sure that this is documented. This is not a left-hand, right-hand transaction. We are setting this up like a legitimate rental. So there's contracts, there's an invoice, there is documentation of the events. We want to make sure that this is clearly defined and clearly laid out. But if we meet those requirements and we keep the rentals under 14 days, you just were able to shift income out of your business into your pocket tax-free, and your business got a deduction. That is a win. This is the power of thinking strategically about what it means to have a tax-free 2026. So next, we are going to go to strategy number 3, which is accountable plans. And let me stop here. I'm going to take a quick sip of water. I want to see if there's any comments or questions coming through. Again, as you're joining, go ahead and let me know where you are joining from. So awesome to have you all here on the live today. We are talking about tips for a tax-free 2026. And if you are just joining, my name is Lauren Ballard. I am a CPA, and I focus specifically on helping business owners, high income earners, optimize their tax strategies so they can keep more of their hard-earned dollars and ultimately create more wealth. So we are going through, and we've been through 2 strategies. The first strategy was the real estate entrepreneur strategy. The second strategy is something I call the master's tax break. And now we are on strategy number 3, which is accountable plans. And this is where we really, as a business owner, if you do not have an accountable plan set up, you are leaving literally thousands of dollars on the table. And I think this strategy, of all the strategies that we've touched on so far, are severely underutilized. So an accountable plan is essentially a reimbursement plan between yourself and your business. So it can be for things like your cell phone, a home office, business travel, client meals that you've paid for out of pocket, but you need to be reimbursed from the business for. And this is the thing, especially as entrepreneurs, we tend to if we get money from elsewhere, we tend to put it right back into our business. If we get paid a salary, or if we take a draw from our business, we tend to put that right back into the business. And so putting together an accountable plan and actually monitoring the inflow and outflow to and from the business really is so important. But also it helps you to capture things that you didn't even realize were actually a business expense. So when we think about this idea of having a home office, so if you rent your own home, or excuse me, if you own your own home and you have an S corp, well, when you have a Schedule C, a sole proprietor, and you file it Normally it's included in your business, in your personal tax return. We're used to getting asked about, do you have home office expense that you need to take? But when we have grown a little bit in our business, we may still be working from our home office, but those expenses are not captured. And so we have business mileage that may not be captured. We have home office deductions that may not be captured. We have, again, business travel, client meals, all these things that we may be paying for personally that are not actually being captured from a tax perspective in the business. An accountable plan allows us to document that reimbursement and ultimately creates another write-off and another tax savings for us for things that we are already spending on. So if you see in this example, we have business mileage of $6,800 for the year. We have a home office deduction of $5,200, business travel of $3,400, client meals equating to $2,800. That is a total of $18,000 that we have spent through the year that we needed to be reimbursed for. And that generates a tax savings of about $7,000 a year. How many people would like to have an extra $7,000 in their hand, in your pocket? I know that I would, because listen, as an accountant, every dollar counts. So we want to make sure that we are keeping tabs and track of that. So an accountable plan requirements, it must have a business connection. So my cell phone, I pay for personally, but I could include this as something on my accountable plan and make sure that the business reimburses me for the use of the cell phone because I use it primarily for business. Substantiation needs to be required. So we want to make sure that we have proper documentation. And then if we are reimbursed, so this happens a lot of times when we perhaps get an allowance for travel. Maybe you've received more than the actual expense. So we want to make sure that we return back to the business anything that we did not need to take for reimbursement. Now, this is the interesting things. Accountable plans. And I found this crazy as I was researching and preparing for this presentation today. I thought it was interesting that accountable plans technically do not have to be written out, right? Like you don't technically need to have documentation. It just kind of needs to be understood that this is how you do it. However, I highly recommend that you put together and put in place an actually a written accountable plan, a written reimbursement plan, not just for you, but also for your employees, so that it is clear the inflow and outflow of cash to and from the business. But this is another strategy that will really impact your bottom line. And now I'm going to breeze through a couple other strategies. These, I could probably spend an entire session just talking about them, but we're going to touch on them because I think that it's important. So entity structuring and income shifting. So everybody is familiar with, we see on social media, get an S Corp. You need an S Corp because it saves you on self-employment tax, which is true because there is something included in the requirements for S Corp designations that you pay yourself reasonable compensation. And so with paying yourself reasonable compensation, you are paying payroll taxes. Therefore, anything that you take out of the business and as a distribution is non-taxable because you've technically already paid your payroll tax. And so you're only paying on the profits of the business. And so this is an example. If you're a sole proprietor and you had $300,000 of profit, you would get hit with self-employment tax of $45,900. Now, if you had that same profit and took a salary of $120,000 and took distributions of $180,000, your self-employment tax would go down to $18,300 for a total savings of $27,500. So that is the benefit of an S Corp. And if you have not made an S Corp election, please make sure you talk to your CPA, tax provider to get you set up if you meet the criteria of where it makes sense, the threshold of where it makes sense to have an S corp. And I generally say about $40,000 to $50,000 in profit, you should be considering an S corp. Now, people love to talk about the S corp and how beneficial it is, and it almost seems like people poo-poo the C corp. And when I say the C corp, that's the inks. Think of Nike, Adidas, right? So INC. And people poo-poo it because they talk about double taxation. So if you get paid from the corporation, you would get taxed as an employee, but then also anything that you take out of the business would be treated as dividend income. So you'd get double taxation. But here is the thing, depending on how well your business is doing, you actually may end up paying less as a C corp than you would as an S corp. And so this is not, S corps are not just a set it and forget it designation for your business. When we are talking about optimizing, we've got to look at this thing from top to bottom to see what actually makes sense. Additionally, this also depends. We also need to consider, what are you trying to do with your business? If you're looking to raise capital, if you plan on doing an exit at some point in time, an S corp may not be the right option from the gate. You may actually need to consider a C corp. So all of those things need to be considered. Let me just show you a quick example of the C corp versus S corp. 80K, we're talking about that tax arbitrage. And so with an S corp, let's say you had 600K of distributions. That's technically, it's not distributions of profit. It would be taxed at 40%. And so your total tax would be $240,000. The corporate tax rate is 21% at this point in time. And so you are saving just shy of $80,000 by it being taxed as an S corp versus it flowing to you and being taxed at the highest tax rate as an individual. So who benefits from a C corp? If you are looking to retain earnings in your business, there is a benefit to a C corp. If you're already in the top tax bracket, a C corp is likely to be a good option for you. If you're building toward a sale or an exit, you should consider it. And if you have 500K or more in profits, you should consider a C corp as opposed to an S corp. And then here's another example. We'll skip past this because I think we've talked about this sufficiently. We have about 5 more minutes, so I want to make sure that we touch on everything that I want to. So we'll touch briefly on income shifting to family. So if you are a high income earner, there's benefit to transitioning income from yourself to a lower or a zero tax bracket to save. So you can do that by paying your children. They're either going to be in a lower tax, usually going to be in a lower or zero tax bracket, depending on their age and stage of life. So that is also an option. And when we talk about income shifting and having our kids do work, it's obviously got to be legitimate work performed. They should receive reasonable compensation. There should be proper documentation. And then the entity structure should support it. That was a tongue twister for me. Because depending on the entity structure, there's different things that happen in regards to those payroll taxes that we've got to be mindful of. So we've talked about a couple strategies for a tax-free 2026. And I hope that at this point, it has been educational for you. But I want to make it clear that a tax-free 2026 does not happen by accident. It happens by intention. And so if you would allow me, I would just like to take just a few minutes to present something that I think will be of benefit to you if you earn 300,000 or more in income. And I call this my tax prep plus package. And so what is that? What we do is that we analyze where you've overpaid in 2025. We determine which strategies apply to you, not just a blanket conversation, but we do a deep dive of the best options and opportunities for you in your financial situation. We'll then present you with a month-by-month action steps, action plan for you to implement. And then we'll also give you insights on what you should be tracking and documenting. And so the Tax Prep Plus package is ideal for high income earners over 300,000, for business owners, for real estate investors, and ultimately anyone who is tired of overpaying. I would say that if your tax bill within the last 2 to 3 years has been at least $15,000, we should absolutely talk, because the Tax Prep Plus package might be a good option for you. And so the investment for the Tax Prep Plus package is $3,700. It includes your completed and filed 2025 tax return. Includes post-filing strategy session, a written 2026 tax plan, a specific action steps, and a 30-minute mid-year strategy session to make sure that you are on task and meeting those tax milestones that we discussed at the beginning of the year. And let me just say this, that I charge $3,500. I'm saying it out loud. I'm not hiding anything. I charge $3,500 just for the tax plan. So the package that we have together that we're presenting here is honestly such a great investment for you. And so if you're looking for a way to get a handle on your tax bill for 2026, and you want to have a professional take a look and see what is going to actually work for you, I highly recommend that we have a conversation and see if the Tax Prep Plus package is a good fit for you. So if you're interested in that, go ahead and comment plus down below, or you can shoot me a message here on LinkedIn. And this package is only available through April 15th. So if you're interested in this, please act quickly. It is only going to last for the duration of tax season. After this tax season, I can't say if I'm going to do this again, but I really want to make sure that tax strategy is available to as many people as want to take advantage of it. So now is the time for questions. I'm going to just switch over and see really quickly if there's any questions. I'm going to head over to the YouTubes and see if there's any questions. Make sure that everybody is good. They're all good. If there's no questions on LinkedIn, I just want to say thank you so much for joining us here today. Okay, perfect. So it was live. So I just want to say thank you so much for joining us here today. If you have any questions, please do not hesitate to reach out. I love to engage and support. And so however I can be of assistance, I would love to do that. I'm also going to put here in the comments I can't talk and type, as you can see. And so if you're interested in booking a strategy session and would love to want to get some more information or more insight, please feel free to book a meeting. I just put that in the chat. You can see that on the stream, and you can see that on the stream. And if you have any questions, again, please do not hesitate to reach out. I'm more than happy to support and answer questions. Please, if you are interested, take advantage of the Tax Prep Plus package. Like I said, that will be gone after April 15th. I don't know when it'll come back, if at all, but this is a great opportunity for you to benefit from a strategic tax plan designed specifically for you. So we do these lives every single month. Normally the second Thursday of the month, we come on and we talk about tax strategy, tax optimization. And so please join us next month. Please give me a follow here on LinkedIn. And until next time, have an amazing day. Have a great week, rest of your week, and have an awesome weekend. I will see you next month. Bye-bye.